Money sitting idle in your bank loses value every single day. But there's a simple way to make it earn money daily with almost zero effort. Say for example, if you have 10,000, 1 lakh or even 5 lakhs lying idle in your savings account earning merely 2 to 3% returns, then this video is for you. Today I will show you how liquid ETFs actually pay you daily, how much you really earn after charges and taxes, which liquid ETFs are best in India right now. Money that is not working hard for you is the money that is silently dying. A savings account gives you roughly 2 to 3%, right? Inflation is around 5 to 6% in India. So every year you are losing money even though the balance looks safe. Your bank is earning more on your money than you are. So the question which might come to your mind is where you can park the money in the short term. Okay, and it should be liquid, it should be safe, and still it can earn better returns than the savings account. That's where liquid ETFs comes in. Liquid ETFs are designed for money you need soon, from 1 day to 12 months, not after 10 years, not after 5 years. To be honest, liquid ETFs are not a get rich product. It's a product where you can park your money, which you need soon. A liquid ETFs takes your money and lends it to bank for very short periods, usually overnight. Banks need short-term money every day to meet RBI rules. They give collateral like government treasury bills in returns. That means the borrower is a bank, the collateral is government backed, the loan duration is extremely short. That means the risk is almost negligible. I know risk doesn't become zero in finance, but realistically it is zero itself. The return you earn comes from something called overnight rate. This rate moves with RBI policy and overall interest rates. When rates are high, liquid ETFs pays more. When rates fall, returns reduce. As of recent years, liquid ETF returns in India have mostly stayed between 5 to 7% annualized. Now, here's the key part most people don't understand. Liquid ETFs don't pay you once a year or pay you in a quarter or pay you every month. They pay you daily. Every single day, interest is added. Let's do a simple math. Let's say you invest 1 lakh rupees. Annual return is 6%. That's 6,000 per year. Now divide that with 365. You earn around rupees 16 per day. That money is coming to your account every single day. It's boring, I know, but boring is powerful when it's consistent and safe. Now, liquid ETFs comes in two types. First type is IDCW, that means dividend paying liquid ETFs. The second type is growth liquid ETFs. In dividend paying liquid ETFs, the ETF distributes income by giving you fractional units instead of cash. So instead of price going up, you get more units slowly. Sounds good, right? But there is a problem. ETFs trade in whole units. If your fractional units don't add up to a full unit, you can't sell them. That means part of your money stays stuck until you get enough units accumulated to become a one whole unit. This is why many people feel confused or disappointed. Now that's where the second type, that is growth liquid ETFs, comes into picture, and it solves that problem. In growth liquid ETFs, you don't get units as income. The NAV slowly increases every day. When you sell, you realize the gain. It works like a mutual fund, simple and clean. Personally, for most retail investors, growth liquid ETFs makes more sense. Now let's talk about real returns after charges. Liquid ETFs have an expense ratio, usually around 0.1% to 0.3%. That means if the overnight rate is 6.5%, you might actually get around 6.2% after the expenses. Still much better than a savings account, right? But that's not all. There are other brokerage charges when you buy or sell. That is brokerage, exchange charges, STT, GST on charges. For most investors, these charges are tiny, but they matter if you are doing very small or frequent trades. Liquid ETFs work best when amount is meaningful and holding period is at least a few days to few weeks. Now let's talk about tax. Liquid ETFs are taxed as debt instruments. That means short-term capital gains tax are added to your income and it is taxed as per your income tax slab. So if you are in 5% slab, tax is low. 20% slab, tax eats more. 13% slab, tax eats a lot of your money. There is no indexation benefit anymore. Liquid ETFs are good for parking money, emergency fund, temporary cash, and trading profits waiting for redeployment. Okay, it's not for beating inflation long term. Most people try to use liquid ETFs like a fixed deposit. They expect guaranteed returns, no price movement, no learning curve, and then they panic when the NAV moves by a few paise. That's the mistake. Liquid ETFs are market instruments. Even if the risk is low, but there will be few ups and downs. If you don't understand how to buy and sell properly, you will lose some money here and there. Now let's talk about the best liquid ETFs in India. Actually, the truth is returns are very similar across the AMCs. So you can choose any liquid ETFs, but there are some things you can look into. That is the expense ratio, the tracking error, the liquidity, the AMC credibility. So some popular growth liquid ETFs, which are Nippon Liquid ETF, HDFC Liquid ETFs, SBI Liquid ETF, Zerodha Liquid Case ETF, and DSP Liquid ETFs. These are very good liquid ETFs in India as of today. Now the thing is, we all chase high returns, right? We go after the stocks, mutual funds, and we chase high returns. And we chase the quick profits, we chase fancy strategies, but we ignore the cash management. Liquid ETFs don't make headlines because it doesn't give you high returns, it does not give you quick profits, it does not fall under that fancy strategies. They don't excite, they are boring strategies. They don't trend, but they quietly protect your money from decay. If you start treating every idle rupee seriously, your financial life changes. This is not about earning more, this is about leaking less. Liquid ETFs are not a replacement for equity. They are not magic income machines, they are tools. If the liquid ETFs are used correctly, they beat the savings account, maintain the liquidity, reduce the opportunity cost, and protect your short term capital. Thanks for watching. If you found this helpful, don't forget to like, share, and subscribe for more insights like this. Thank you.